Welcome back to Financial Times in the car line. Buckle up for safety. Let's jump into it. We got about another 15 minutes that I can talk about some financial things that I want you to know. This one's an investment vehicle, Universal Life Index Fund, IUL. Index Universal Life Fund. I don't. I can never remember the exact phraseology of exactly what they call it. It's IUL. So it's a insurance policy. Let's ask Grok real quick. Hey Grok, is it IUL, Universal Life Fund? How do they say it? How is it abbreviated? Let's ask Grok.
Hey, it's usually pronounced IUL as letters, standing for Indexed Universal Life. That's the common
Index Universal Life. All right, so let's get into it. I will jump straight into mine and let you know kind of the ins and outs of how mine operates. So mine is about $650 a month. It's $1 million policy, and it's a cash value starting at year 4. I am 3.5 years deep into it, and what it does is it builds a cash value. And when I said cash value starting year 4, this is an opportunity for you to put money in. And let me just start by saying, I'm 46 years old. So I've been doing this since I was 43. And if I started this when I was 33 or 23, I can give you a prime example. So I met my insurance guy for lunch, and I was with my business partner and a friend of mine. A friend of mine is actually a lot younger than me, 29 years old. He got the same life insurance quote, and I want to say it was around $240 a month. So it just goes to show you, the longer you wait, the more expensive it's going to be. So what this insurance policy does, though, number one, it gives you a death benefit. So my death benefit's $1 million. So if I pass away tomorrow, my family gets $1 million. Don't tell them, because you might find me on no, I'm just kidding. But so what it does is it takes that $650, a strong portion of it, and it invests into S&P 500 funds. So it's almost like a stock account, but it's an insurance account. You can't touch the money, but once year 4 hits, an accumulated cash value becomes available for me to use it as I see fit. Here's the best part. I can withdraw that money tax-free. 0 taxes. I can then either replenish it and just keep on paying the premium, or I can cancel the policy and just be done with it. On the flip side, I could take a loan out against it. A lot of policies, the majority are not fixed. So just pay attention, what their rates are. A lot of them say that, we'll do prime rates or prime +1, whatever it may be. So just keep that in mind. So with that being said, you can either take a loan out starting year 4. Some even start day 1. So there's some policies out there. I actually looked at a policy, and I was going to enroll in that one because that was a day 1 policy. And what a day 1 means is that the second you make your first premium payment, they're asking for donations in the car line. So if you see 2 people walking by with funny hats, that's why. But day 1, the first time you make your premium, you are eligible to withdraw or lend against that account. So some don't have vesting periods. There's also a product called a Kaizen, Kaizin. If you want to look that up. Again, I'm not a financial professional, not an insurance professional, but these are the products that I looked at. The Kaizen was a lot more expensive. It was like $2,400 a month premium for a $500,000 death benefit. But here's the wild part. That $2,400 a month was going to be invested, and all I had to do was invest that for 5 years, and then boom, done. Never a premium would you ever have to pay again. The bank pays your premium going forward. So if you're young enough, look at the Kaizen product. Typically you have to have a certain net worth, I believe. So just keep that in mind when researching that product with your insurance professional. You may or may not qualify for it, but if you do, awesome. That is something that You ever hear the term generational wealth or infinite banking or be your own bank? This is the product they're talking about. They're talking about the universal life index funds or this Kaizen product. It's something to where you're putting money in month over month and you're building generational wealth. So just to give you an idea, at the beginning of year 4, as long as let's talk about percentages first. So every year you have, you ask, well, what happens with that $650 since they're investing it for you into S&P 500 funds. So I have a floor of a ceiling of 13%. So if the S&P 500 does better than 13%, I'm capped. I can only take the 13% gain. However, if the S&P 500 crashes by 13%, I have a floor of 1%. So I will actually never lose money in this account. It's an account to where no matter how the market performs and no matter how bad the economy is doing, I will actually never lose money in this account. That's the good thing about these accounts. So when you're talking to your insurance professional, ask them what's the floor, what's the ceiling, because different insurance companies have different floors and different ceilings. Some, when I was looking at them, some had 6% ceilings, some had 12% ceilings, some had 14% ceilings. Like the one I got into was 13.1%. So at the beginning of year 4, let's go back to dollar amounts. I want to say last time I checked was like 2 or 3 months ago, but right now the projection for me at the beginning of year 4 is roughly $58,000. So that means on day 1 of year 4, I can go in and take out that 50 some odd $1,000 either as a loan, or I can take it out tax-free as money in my pocket to go start a business, invest, do whatever I want with. So that's what makes this infinite banking. So your goal should be, if you have a product like this, if you're going to take out a large portion like that, have it be for an asset that returns money. So if I'm taking out $58,000, start a business, buy a rental property. That way you could pay the $58,000 back, because once you take that $58,000 back, you then have to regenerate again. You got to regenerate the funds. So you want to make sure you're taking that money out for a strong investment to get a return that you could then put it back into the Universal Life Fund. So that's kind of it in a nutshell. The sooner you start, the better. Don't wait till age 43. It's a very in-depth process to get this product. The majority of times you're going to have to do blood work. They're going to send a nurse to your house. They're going to take vials of blood. They're going to take a urine sample. They're going to get you on the scale, measure your height, your weight, your waist. They're going to do a body mass index, because they're not. This is a product that I hate. It's what we talked about: infinite banking, be your own bank, generational wealth. They're not going to give this to just anyone. So if you've got a massive amount of health issues, go apply for it, see if you get approved. If you get approved, sweet. If not, they'll tell you why you don't get approved. Now you know what to work on. Take 3 to 6 months, get healthy, get your A1C in check, get your blood pressure in check, get your cholesterol in check, get on a better diet, get to the gym, lose some weight, whatever it may be. Help yourself, help your family move forward. This is something that, $1 million policy is a massive chunk of change that if I pass away, I know my wife and my child are taken care of. The rental properties are going to be taken care of. The house is going to be taken care of. All the bills are going to be taken care of. And they can boohoo and grieve me for the rest of their days. I'm just kidding. They better move on and take that money and do something strong with it. So keep that in mind. Start early, start young, start fresh. A lot of people put this stuff off. A lot of people don't even learn about this until they're later on in their 40s and 50s. So just keep that in mind. So if you have any questions, comment below. I'll put a link to the guy that underwrote my Universal Life policy. He does all my insurance, my rental properties, my car, the wife's jewelry, all of our possessions, homeowners insurance, everything under the sun. So rock and roll. I don't know what else to tell you other than you want to know what I'm going to use it for? So All right, so that's a good question. So I'm asking myself questions ahead. So what am I going to use the money for on year 4, 5, and 6? It's going to be investing into businesses. It's going to be going into potential car washes down here in Florida, putting money into storage facilities. My business partner and I are looking at multifamily properties. That's the thing. If we need money, it's there to draw against. But that's my goal as to what I'm going to be using it for. I'm not going to just withdraw it to go take a vacation. I'm going to withdraw it to make more money. I'm going to make my money work for me rather than me working for my money. So by all means, if you start fresh and you start young, you're not talking about this at age 46. You're talking about at age 32, 35, 36, age 40, doing this stuff. I'm not behind the 8 ball. I've done a lot in life, but I was more focused on my career rather than focused on all the outside stuff. And I wish I had a mentor, like myself, talking back, and listening to these videos. But that's the way the cookie crumbles. Better late than never, right? Anyways, Financial Times in the car line. I see all the kids coming out. So y'all be good. Take care. Have a great week.